Lee, one of the things that's been so interesting is watching what's happened to technology stocks. That's a place where people say, look, they'll defy all of this other things that could be pressuring the major averages or some of those other stocks. Do you buy into any of the growth prospects for the technology stocks that have already seen big run-ups? In fact, NASDAQ up, I think, 9% just this week.
I would say that if you look at interest rates and you look at the growth rates of these companies, they're not irrationally priced. They're not cheap, but they're not irrationally priced. I mean, Google 35 times earnings, Microsoft 33 times earnings, MSI, Motorola Solutions 21 times earnings, Facebook 32 times earnings. Let me just give you a statistic. If you go back to 1972 Nifty 50, they were selling at 50, 60 times earnings. The 10-year government bond was 6.5% on average for the year 1972. The 10-year government is 70 or 80 basis points. So, if you apply today's interest rates against these companies' growth rates, they're not expensive. You go back in 1972, Sears Roebuck, not around anymore, 40 times earnings. Kmart, 35 times earnings. Xerox, 40 times earnings. Polaroid, 90 times earnings. We don't have that today. So they're not cheap, but they're not really expensive against interest rates that exist. So you can come up with any valuation you want to come up with and justify it analytically. I have big positions in Google, Microsoft, MSI, Facebook, Amazon. I'm not a buyer at these prices, but I tend to buy things that are lower, but I'm not selling them. I think that these are better than gold, in my opinion.
Shepard Smith here. Thanks for watching CNBC on YouTube.